So welcome to our discussion of the conceptual framework for financial reporting. Now, as you probably know, because we're going to treat this from a third level perspective. All right. So as you might have come to know from your first level, we cover a little bit of the basic concepts of the conceptual framework. Also at second level, we do cover that. But at third level, it just goes a lot deeper. So what we're going to focus on in this particular discussion of the conceptual framework we're going to focus specifically on the elements of financial statements, because at third level, those are very popular questions. They will give to you a particular transaction or a particular economic phenomenon, right? And then they will require you to determine if the transaction or if the economic phenomenon meets the definition, maybe of any of the elements. It could be income, expense, or whatever. Or they could ask you in the similar line to determine if it should be recognized. So with that, let us start by two things that are very important in our understanding and application of the conceptual framework. So the first thing that we need to know in our conceptual framework has to do with what we refer to as recognition. All right. So recognition means that we are going to record a transaction in the accounting records. So recognition could be journalizing as well. You could talk of recognition as journalizing. So a question could be asking for the recognition of a particular transaction. In other words, how is it going to be recorded in the journal entries? Then we also have presentation. So presentation is basically how is it going to be summarized, right? For example, if it is land, then you know that land is going to be presented under PPE, right, as a non-current asset. So that's the presentation. So we have to pay attention to these particular words. So we can talk of the recognition and presentation of certain economic phenomenon. Recognition is the recording in the journal entries in the general ledger. Presentation is the summarization in the financial statements. All right. So remember, the financial statements is categories. And as an example that I gave, we have land which falls in the statement of financial position under non-current assets, under assets, then under non-current assets, then in the line item property, plant, and equipment. So that speaks to presentation of the land. Then we also have what we refer to as disclosure. All right. So a disclosure could also include some elements of presentation. Excuse me, but disclosure in most cases typically refers to disclosure in the notes. We can also disclose, like I said, in the financial statements, but in most cases. So when you come across a question that wants you to disclose, you need to pay attention. Where are you going to disclose that? If the question is silent about where do you disclose that, then you consider disclosing that in the notes as well as the financial statements. For example, if you are going to disclose inventory, let's say the economic phenomenon has to do with inventory, for argument's sake. Now, you know that inventory is going to be, so you're gonna say maybe ABC. Let's say that's the name of the entity, ABC Limited, extract of the statement of financial position, because that's where you're going to record your inventory. Then you come under assets, all right. Then you come under current assets. Then you record your inventory under there. Not so. Because they haven't told you the disclosure they require. Is it in the notes or financial statements? Then in the notes as well, you have to disclose your inventory under notes according to the requirements. Should there be any disclosure that has to be made? So the point I'm making here is not specifically about how to disclose inventory, but about the term disclosure. So if they say disclose, you could disclose in the notes or the financial statements, in the statement of profit and loss or other comprehensive income, in the statement of changes in equity, in the statement of financial position. All right, you disclose, or you disclose in the notes. So you need to pay attention where exactly does the examiner want you to disclose the item. Right, so those are the three things we've spoken about. We talk of recognition, we talk of presentation, we talk of disclosure. And now let's go to elements. So as you know, we have 5 elements of financial statements, which you should remember from your earlier studies. So we have assets, we have equity, we have liabilities, income, and expenses. Now, at third level, it's not just about identifying whether something is an asset, but we're going to go into an economic phenomenon, a transaction that is given to us. Then we determine whether it meets the definition of equity, whether it meets the definition of an asset, and whether it should be recognized as well. Then if it is recognized, we might be interested in knowing how we are going to present that in the financial statements, as well as any disclosure requirements. So we have 4 steps that could be examined to us. The first step is whether an economic phenomenon meets the definition of one of the elements, right? And if it does meet the definition, then we have to ask ourselves if we should recognize that. So we will explain to you the various definitions, all right, and the recognition criteria that is used. Because something can qualify by definition to be an asset, but then we're not going to record it in the accounting records. Why? Because it does not meet the recognition criteria. Remember, recognition means recording in the financial records. So it doesn't meet the criteria, therefore it won't be recorded. Then the next thing we want to know is how are we going to deal with it? So then we can have a presentation in the financial statements or a disclosure. So the things that are disclosed in the notes could be those things that are recognized or not recognized. All right. So you will understand these things as we go on. This might appear technical, but that's what we're going to consume. For those who are doing the VEA module, we're going to be consuming these things for the entire year. If you're doing a semester module, right, you would have your meal saved by the end of the semester. So let's start with this particular question that focuses on assets. Okay, so no, this doesn't say yeah, but that focuses on assets, right? I don't know if I introduced my name to you, right? Because I think I just went to the concept, the technical stuff that we need to discuss. But I'm Thomas, if you are interested. If you don't know me, my name is Thomas Maluleke, and I'm a tutor with TopCrest Online. So sometimes we do provide you with students, rather. We primarily focus on UNISA students. Sometimes we provide you these free resources that can just help you here and there. But if you are interested in joining classes, tutorials, extra classes, you're welcome to inquire from us. So we do put our number there, and of course our website. So let's start with an asset, and we start by looking at the recognition requirements of an asset. So we have we're going to approach this from an example perspective. We're not just going to discuss the concepts, all right, the technical points, but we're going to discuss them as we apply to an example. So here's our example. So on 30 December, right, with our entity ABC, ABC made a payment of 85,000 Rand to XYZ. All right, now XYZ is a popular television network. And so what ABC is doing is that they want to advertise their guest houses. Then they signed a contract that says XYZ, that says that the advert will appear in the channel for the next 6 months, starting from 1 January 2024. All right. ABC will choose the time slots of the advertisements. Okay, so that's the story. In other words, we refer to that as an economic phenomenon. All right, or the story we have listened to. Then we have a required, based on that economic phenomenon, we need to know, we need to discuss, rather, in terms of the conceptual framework for 2018, whether the payment to XYZ may be recognized as an asset in the financial statements of ABC. So previously, we just used to know that it's a prepayment, right? And it's a current asset. And we would put it as a current asset. But now we have to discuss the points according to the conceptual framework as to whether that should be recognized. Now, I want you to pay attention to this particular required, because this particular required says whether it may be recognized. Okay, it doesn't say whether it meets the definition, because the first thing is that something must meet the definition of an element. Then when it meets the definition of an element, we consider whether to recognize it as a second step. So when the examiner asks you if something should be recognized, it means you have to go through the first step of determining whether it meets the definition of the element. And so at third level, you need to know the definition, the technical definition, as stipulated in the conceptual framework. The actual words used, not what you think, not what would make sense, but the actual wording used. So you need to know the technical definition of each element of an asset liability. Then we will help you now from these discussions to apply that to particular transactions. So we're talking of an asset. So our first step number one, right, in approaching that particular question is to provide the definition of an asset and the recognition criteria. Okay, so in your answering that question, you have to explain what the recognition criteria is in the definition. So the definition of an asset is, and this is what you will have to write in response to the question. You have to write the definition of an asset. So an asset is a present economic resource. So that's the first thing. It is present. It's an economic resource. It's controlled by an entity as a result of past events. And because we have a term economic resource, we need to know what that means. So an economic resource is a right that is the potential to produce economic benefits. So that is the definition. Now, before you recognize something as an asset, it has to meet the definition. Then it also has to meet the recognition criteria. So what are we interested in this definition of an asset? We want to look for a right, because that's the economic resource. So that's the first thing, it's a right. Then the second thing is a potential to produce economic benefits. So we have identified an economic resource. If we identify these two, the right and the benefits, then we go to number 3, which is control. And we have to look for evidence that the entity can control that right. Right. And then we need to identify finally that the past event that actually allows us to have the right, what happened previously. So these are the four things that we need to identify when we're dealing with an asset. We identify the right, we identify the potential to produce economic benefits. So we're going to discuss these four items. Then when all four have been met, then we know that the first requirement of the definition of an asset has been met. Then the second is the recognition criteria. So the first one is we're going to recognize as an asset if it meets the definition. That's the first one, as well as the recognition criteria. Then the recognition criteria says we only record assets and any resulting income or expenses. We only recognize them if this information will be useful. That's the recognition criteria. So when you answer such a question, you just have to repeat that because it's basically what the conceptual framework prescribes. Right? So the information has to be useful. And for information to be useful, it has to be a relevant and faithful representation. So we first of all go through the definition, and then when something meets the definition requirement or definition criteria, then we go to the recognition criteria as well. Then when it meets the definition criteria, we can say yes, it's going to be recognized as an asset because it meets the definition, it meets the recognition criteria. So that's how you approach such a question. And then that was the step number one. So on your first step, you need to provide the definition of the element we're talking about and the recognition criteria of that element. And of course, the recognition criteria of all elements is going to be plus or minus the same. That's right. So that's the definition which you must know from the top of your head. Right. Then step two, we now want to apply those key components that we've been talking about. So it's actually 6 key components, right? For an asset, it's the right, then economic benefits, not just economic, potential to produce economic benefits, then control, then past events, then relevance. So if you want, if the information is going to be relevant, if the information is going to be faithful representation, then from there we can say, yeah, it has met the definition and the recognition criteria. Right? So let's go to rights. Does ABC have a right? So ABC has the right for the advertisements to appear in the television channel at its chosen slots for the next 6 months due to the payment which has been made. So how do you address the issue of a right? Okay, so when you're dealing with a right, you need to identify the right. All right. So in the transaction, you need to identify the right. Just now, we're going to explain to you what kind of rights you can expect. And then you need to identify the rights and how they arose. So when you answer question about right, you need to demonstrate your awareness to the examiner that you are aware of that you need to identify what's the right and how did the right arise. So those two are going to answer this first point number one. Does the entity have a right? So you identify the right that it has. In this case, it has the right to have its advertisements appear. That's a right. And you identify how did that right arise? Because they made a payment. All right. So they have a right, you identify the right. And how did the right arise? Through payment. So point number one, we have identified that indeed there is a right. Now let's talk a bit about rights. Right. So right, there could be a lot of rights. It could be a right to receive cash, right? It could be a right to receive goods or services. It could be a right to use whatever it is, whether it's property, plant, and equipment, whether it's intellectual property. It could be a right to benefit from an obligation of another party to transfer an economic resource to us, like, for example, insurance. If we have a right to receive some insurance, then that could be an asset, right? Because let's say something has happened and we have satisfied the requirements for the insurance and we're waiting for that to come. So that could be an asset that we're waiting for. We could record an asset, right? Not really record, but we could have an asset. So another right could be an exchange of economic resources with another party on favorable terms. So in that exchange transaction, we're going to gain. Right? So these are examples of rights. And you cannot exhaust what those rights could be. It could be right to explore minerals in South Africa. It could be a right to do whatever. All right. Do something. What are you authorized to do? That's a right. So when you deal with that concept, you make sure you identify the right attached to that item, right? So that's the first thing. Then the second thing is to identify how those rights were acquired, right? So when you do that, you have to look out for so the most obvious ones is through a contract, like in this case, they signed a contract. Some could be through legislation, where the government, for example, gives a law or an act of parliament, and that entitles you to something because of your position. So you now have acquired a right through legislation, through a contract, or you can acquire a right through, you can buy, right? For example, what is those things called? A patent is a patent. I don't quite know what those things are. Patents, copyrights, so I think that is intellectual property, right? Or some secrets that you have, like some secret ingredients for making some delicious soup, and nobody knows that. So the fact that you have acquired the knowledge which no one else has constitutes you acquiring a right, because you have a right to use that knowledge to better your business position. So you need to look for how the right was acquired. Okay, so another party could have an obligation that it has no practical ability to act in a manner consistent with its customary practices, policies, or specific statements. So how do we acquire a right? Let's say we are a shareholder in this particular case, right? And we're a shareholder in Anglo American. Let's say we have 1 million shares. Then Anglo American declares dividend to pay 1 rand per share. So we can actually record an asset of 1 million rand as under trade and other receivables. That's an asset, right? Why? Because now, because of their specific statement that they have declared on that 1 rand per share, under normal circumstances, right, they do not have a practical ability to not pay that dividend, which they have declared. So this is how you can acquire a right as well. And here's something that is very important. So where the existence of rights is uncertain or is not yet established, there is what we refer to as an existence uncertainty. Because there is an existence uncertainty, we're not sure whether we actually do have a right. And as a result, we cannot say a right exists. When a right does not exist, then the asset does not exist as well. So what we might have here is we might recognize what we refer to as contingent asset. When we are uncertain, but there is a likelihood, a high likelihood, but this uncertainty is not resolved, but there is a high likelihood, right? Then we have what we refer to as a contingent asset. Now, a contingent asset is not going to be recorded in the financial statements, but will be disclosed in the notes to the financial statements. All right, so what have we done so far? We have spoken about the definition of an asset, and we focused on the rights. So we said when you deal with the right portion of the question, identify the right, and then how it was acquired. That's how you answer that question, right? Then what else do we have? All right, so we are now applying. Right, then we have the potential to produce economic benefits. Remember, we said an economic resource is a right that has the potential. Okay. So the potential to produce economic benefits for the entity doesn't have to be certain, or doesn't have to be probable, doesn't have to be even likely, right? As long as there is a potential. So what we need there is that the potential has to be there. Just any potential, at least in one instance, at least some potential. Once that is there, then this potential to produce economic benefits is there. All right. So we have a right, and then in at least one instance, there is a chance that the right will produce economic benefits beyond those available to other parties. Now, if you go to this particular question, if you apply it to ABC, so ABC paid XYZ, right, so that it can advertise for the next 6 months. So we can argue to say this right to place advertisements has the potential to produce economic benefits for ABC in two ways, right? So there are two ways that can happen. The first way is that we could advertise, and then we have cash inflows as potential clients respond to the adverts. So that's a potential benefit. Then there is also a chance that in the future, if we were going to advertise, right, we are not going to pay because we've already paid. So the benefit here is reduced future cash outflows, right? Because we've already made a payment. So we have a chance that we don't have to advertise again in the future. So we have reduced future cash outflows, and there's a chance for increased future cash inflows. So those are the two examples of benefits we can get in this particular case. So there is a chance, right, at least one instance, and we have a chance in at least two instances in this case. Okay, so then we go to the concept of potential, because that now has to do with probability, likelihood. So we're going to discuss the concept. Sometimes, what about if the chance to produce economic benefits is low? We don't care. All right. So if the chance of the probability or the potential to produce economic benefits is low, we don't care. When we are still under the definition of an asset, we don't care about that. We just need at least the potential. If the potential is there in one way or the other, at least we're gonna say there is a potential, right? So the low probability of economic benefits does not prohibit the economic benefit from being an asset. All right. But if the potential to produce economic benefits is low, that's going to affect the relevancy when we deal with the recognition criteria. Remember, there are two steps: the definition of an element and the recognition criteria of that element. So when we are still dealing with the definition, we don't care about the low probability as long as there is some potential in at least one way. Then that can meet the definition of an asset. But in a case where there is a low probability, which we refer to as an outcome uncertainty, we're not sure exactly whether the benefits are going to happen, then we might need to disclose then this is going to be affected. What information to provide, how to provide that information, whether the asset is recognized, and how is it measured. So all those are going to affect what we refer to as the recognition and disclosure. So this is disclosure. All right. This is the recognition. Okay. Brilliant. So at this stage, we're not very much, even if the probability to produce the potential to produce economic benefits is low, that does not prohibit the economic benefit from being an asset. So examples of economic benefits, in this particular case, we identified two, which was a reduced future cash outflows, or a potential for increased future cash inflows. So we could receive contractual cash flows or another economic resource. Let's say we, for example, a fixed deposit, and we have 10%, so we can receive cash, contractual cash flows, or we invest in bonds or whatever it is, debentures. All right, those financial instruments. So that's an economic benefit. So we could have a chance to exchange with another party on favorable terms. In other words, we do an exchange and we gain. So that's a form of economic benefit. Or we could extinguish liabilities by transferring the economic resource. So that's also a gain, because we no longer owe somebody. We use that economic benefit, right, to reduce what we owe. So that's a benefit, that's a gain. So we could receive cash, we could produce cash inflows, or avoid cash outflows, like in our example. All right. So, and that can happen if you use the resource, if you combine the resource, and if you use the resource individually or in combination with other goods or services that we have, or we could use the resource to enhance the value of other economic resources, or we can sell the resource or whatever it is. So far, let's provide a summary, right, of what we have covered. Right, so let's provide a summary. So you're going to provide a definition, notice of the, and the recognition criteria. That's step one. Step number two, you're going to focus on the application. So you're going to focus first on the right, whether, what, so you need to identify rather the right and its source. This is what we have agreed so far. Then you need to identify the economic benefit. So what's the benefit? And so I've given you examples of benefits we can identify. So for an economic benefit, you need to identify. All right. So normally it's straightforward for you. So now we need to know the control aspect. Does the entity control that economic benefit, that right to the economic benefit? Does the entity have control? So control means you have the present ability to direct the use of the resource. You decide how to use the right. And then as you decide how to use the right, you obtain the benefits, all right, from the resource. So that means you have control. So when we look at control, because remember, an asset is a present economic resource controlled by the entity. So we have to also touch onto the control aspect and say, is there control here? So control is when we decide how to use the right, and then we make sure the benefits that flow from that resource flow to the entity. Or control can also be there if we can prevent others from directing the use and obtaining the benefits. So if it is something like a secret, then obviously you can prevent others from knowing your secrets, right? So you have control. All right. And you can use your knowledge, right? Your know-how, and you obtain the benefits. Then you have control. So sometimes you may not have a legal right, like it's not registered, like it's an intellectual property, but it's just your knowledge that you have. As long as you can make sure that others, as long as you can prevent others from using that and obtaining those benefits, you have control over that. So now when we talk of control, let's talk about how control is acquired. Do I have some notes on that? let's talk about yeah. So control in this particular case arises from the legal rights through the underlying contract, because payment has already been made. There's a contract, there's payment, so we actually have control arising from that. And we also see that we have the ability to decide how to use the asset by directing the time slots that the advertisements will be placed. So we need to see the ability to direct the use of the asset. Okay. Do we have the ability to make sure that this happens? All right. So then once it does that, we are the ones, or rather ABC will obtain the benefits, because these benefits the advertisement will obviously will be in the name of ABC, like book with ABC, the best, blah blah blah, and people will have to book with ABC. So in talking about control, we identify whether the entity can direct the use, right, and whether it can prevent others from benefiting. So basically, if it does that, it has control. It obtains the benefit and stops others from enjoying those benefits. Then the past event in this particular regard is the contract that we had and the subsequent payment, because we need both, right? We can't say we just sign a contract and then it's an asset. No, because it has to be paid for. Or we can't just pay for to a SABC without a contract. We just pay into the account and we say we have an asset. So there has to be, in this case, a contract and a payment. So that entitles us. That's the past event that gives us the rights. And when we talk of the past event, we're talking of things that fall within the date of our reporting period, because we're going to report on 31 December 2023, and we need to know whether on the 31st of December this is an asset. So if you look at everything, this has met all the requirements of an asset. Therefore, this is going to be an asset. Now we need to go to the recognition criteria. Should we recognize it as an asset? So now there's a recognition criteria, and we say we only recognize elements that meet the definition of an element, rather, and also the recognition criteria. The recognition criteria is recognizing an element should provide useful information, and useful information has to be relevant, has to have faithful presentation. So now we're gonna examine this asset in terms of whether recording it is going to be relevant or a faithful representation. So in dealing with that, we address for relevance, we have two uncertainties. The first uncertainty is existence uncertainty. Do the rights really exist? Right. So that's the existence uncertainty. Then we also address what we refer to as an outcome uncertainty. These two forms of uncertainties come under relevance when we consider the relevance of recognition. So outcome uncertainty is, do we know the time and the amount of the benefits? Okay, so that's what we're gonna look at. Remember, we've already identified the benefits. Now we need to know the timing and the amount. Right, so if we look at the existence, we actually have a contract in place that was signed and a payment was already made. So the prepayment actually exists. All right, so the prepayment is valid. So there is no existence uncertainty. So we have cleared that concept of existence uncertainty. There is no existence uncertainty. Now we come to the problem of outcome uncertainty. So when we deal with outcome uncertainty, we look at the timing and the amount, especially the amount, right? So the first benefit we're going to get is future cash inflows from future accommodation. But do we know how much we're going to get from advertising? we can't. We can try to have probabilities, but they will have a high level of measurement uncertainty. Right. So there's a high, it's very difficult. In other words, what we're saying when we talk of a high level of measurement uncertainty, we're talking of we can't say an amount with certainty, right? And when we talk of measurement uncertainty, we're not saying the amount, there should be a single amount. There should be an acceptable range, which is acceptable. But in this case, the problem we have with the measurement uncertainty is we cannot quantify the value or number of sales that will occur as a direct result of the advertisement. We don't know if somebody comes tomorrow, we advertise today, if somebody comes tomorrow. We don't know if that somebody who comes is as a result of the advertisement or maybe something else. We need the direct consequence. So that direct consequence is a very high level of measurement uncertainty. As a result, with this first benefit, which is the increased cash inflows, we can't say, right? We can't say we should know the outcome. However, there is another benefit. There is a second benefit, which is reduced future cash outflows. And there is no measurement uncertainty in that because we have already made payment. All right. So under the second potential benefit, it doesn't have measurement uncertainty. We have made 85,000 Rand. So which means that in the future, we don't have to pay that 85,000 Rand again. So in that particular case, we have measurement certainty. So what is this called? The second benefit can be recognized, right? Because it meets the relevance. It's relevant and it also avoids the measurement uncertainty, right? So in terms of the outcome uncertainty, we have seen that we can put in fixed amount here on this on the second benefit, but not on the first benefit. So when we come to faithful representation deals with one thing, which is measurement uncertainty of the chosen benefit. But the benefit we have here does not have a measurement uncertainty because we chose remember there were two potential benefits, right? Then we chose one because it does not have measurement uncertainty. The reduced future cash flows. So we can say there is no measurement uncertainty, and then the payment meets the recognition criteria. Then the step 3 is to make a conclusion that the payment can be recognized as an asset in terms of the conceptual framework at this date. Right? So what have we done so far? If I can remind you the things we've looked for. So the first step, we said step number 1 is to provide the definition of an asset and the recognition requirements. So the definition of an asset is a present economic resource, all right, controlled by the entity as a result of past events. And then we go to the recognition criteria to say only assets and their income and expenses that result will be recognized if they provide useful information. Useful information should be relevant and faithfully presented. That's the first step. You can never go wrong with the first step, right? Because you just provide the definition of an element and the, the recognition criteria. Now, for an asset, you go to application to the case. So you need to talk of rights. So you need to identify what's the rights, what can they get from that, and how did those rights arise, right? Then we have the economic benefits. You need to identify the economic benefits. And we gave you examples of the things that you can look for, and you say, this is a benefit. So in this example, we identified 2 economic benefits: the benefits of potential future cash inflows and reduced future cash outflows. Right? Then, so that's the right economic benefit. Then control. We need to demonstrate that they can direct the use of the right? And they can prevent, they can actually obtain benefits by doing so. And these benefits should be beyond those which are available to others, right? Then the past event, we need to identify the past event and that it. So in talking of the past event, we need to look at the action that gives rise to that right. Okay. And the reporting period. Okay. Then if it meets all these, then it has met the definition of an asset. Then we say, yes, it is an asset indeed. Then from there, we go to recognition criteria. Under relevance, we need to know if we are certain that the rights actually exist. And we need to know whether we can measure them. Is the outcome, the amounts, can we have certainty about the amounts? Faithful presentation talks of measurement and certainty. So if both relevance and faithful presentation are met, then we can say it meets the recognition criteria. It can be recognized as an asset. So step 3 is to make the conclusion based on the discussion from step number 2. Okay, so that was the discussion we had. I hope you guys have enjoyed it. All right, so you can try to write this question down, right, and see if you can answer the question.